Now back to Money Talk on News Talk 580 CFRA.
Well, it's a pleasure to welcome Robert Lloyd George, who is the founder of Lloyd George Advisory in Hong Kong, to Money Talk. How are you, Robert?
Very well, thank you, John. It's a pleasure for me to be on the air with you again.
You have been wandering around the world this summer, and you did spend some time in the west of Canada, and I'd love to hear your perspective on Canada vis-a-vis all these other interesting places that you study.
Well, I should confess that the reason I went to Vancouver was because my 18-year-old son has decided to become a forester and an arborist, and the best opportunity in the world for him was to start his career in British Columbia. And so I spent several days settling him in Vancouver, which I think is the most wonderful city. I was last there in the 80s interviewing the lieutenant governor. He was a Hong Kong Chinese who came over and made a fortune in real estate and became lieutenant governor. And it was very interesting at that time to talk about the influx of Chinese, which has now become much, much more important, and I believe is a third or something like that of the population in Vancouver. And so I think that's a wonderful endorsement of Canada's attractions to investors from around the world, especially from China, Hong Kong, Taiwan. And I went on to Toronto, and I again was tremendously impressed by the warm welcome which Canada gives to so many people from different parts of the world, which is quite in contrast to the United States. So I just feel Canada's got it right, and it has a very bright future in terms of attracting talent and capital from many areas of the world, especially from Asia.
And I think our politics are somewhat less volatile than those in the United States.
That's for sure, yes.
Now, taking a look around the world, we're post-Brexit. We've had lots of noise coming out of the Federal Reserve Board, and you have written a very good September newsletter, Investment Outlook, and let's start with your macro perspective on what's going on in the world these days.
Well, I quoted Maynard Keynes, who said the market is a weighing machine as much as it is a voting machine. And in the short term, it's a voting machine. But in the longer term, I think it has to reflect the real developments in the global economy. And what concerns me most of all today is what I see as the continuing slowdown in global trade. I was in Singapore in June, and we saw for the first time in 25 years, their container port was about half empty. So that was a pretty striking thing to see. And now we have Hanjin Shipping going bankrupt, the biggest Korean shipping company last week. And clearly there's massive overcapacity. The Baltic Freight Index is at an all-time low. It's bounced a bit since that bankruptcy because, of course, a lot of capacity will be taken out. But I think it's a much bigger problem. And I think overcapacity and oversupply in so many areas from oil to steel to iron ore is plaguing the international markets. And so I try to sit back and think, well, who are the winners and losers in this environment? And I think the open, smaller global trading economies, whether it's Japan and Korea, particularly Hong Kong and Singapore, and I also think of the UK, which I believe is going to be very vulnerable now without the EU support, those are going to be vulnerable to a slowdown in world trade because they depend so much on foreign trade. The big continental economies, by which I mean the US and Canada, China, and of course India, have large domestic economies and large domestic populations which will support a consumer-led economy rather than an export-led economy. So when I look around, and China's foreign trade is about 60% of GDP, whereas India's is 12% or less. That means that India really doesn't feel the slowdown in international trade and orders from the EU and North America. So I think that the next 2 or 3 years are going to be difficult for investors, but we can find real growth and real value in some of these areas in the subcontinent, India and its neighbors.
Where are you allocating money these days, taking into account the scenario or the description that you just gave us, starting with, say, Hong Kong and China?
Well, I'm pretty cautious about Hong Kong. I think we've still got, as we did back in 97, high wages, high rents, very high property values. All of those will deflate. The Hong Kong dollar is still linked to the U.S. dollar, so it's a very expensive place to do business, as indeed is Singapore. In China, I avoid all the state-owned enterprises, all the big oils, telecoms, banks, and I focus on the special situations, which in our case we're looking at travel and tourism. We got a couple of great companies there, like China Lodging, which is a hotel chain, and Travel Sky, which is the online booking agency, and education, where we've got 3 companies that are providing English language and business education to middle-class Chinese students, and healthcare. And there we've just invested in a Chinese traditional medicine company. So I think those areas where it's discretionary consumer spending will continue to do relatively well, and we see retail sales growing 11-12% in China, even though the industrial economy is flat on its back and the export industries. So I think this is still an area where you need to be very selective. But healthcare, education, and tourism remain strong.
And what sort of allocation as a percentage of your portfolio would you be making to China?
Well, we've still got around 20% in those special situations, not very much at all in Hong Kong, around 20% in India, around 10% in Australia, and the same in Japan, smaller weightings in Korea and Taiwan. We've started to buy in Vietnam. We've got a couple of stocks there, only 2 or 3%, in Indonesia and in Sri Lanka. So we're looking to the frontier markets now for, I think, value and growth.
And then you do have investments in Australia, and it's somewhat analogous to Canada.
Yeah.
What sort of investments are you making in Australia?
Well, our largest position actually is an Australian healthcare company called Nanosonics, and it makes the cleaning equipment for post-operative conditions in hospitals. And I've interviewed actually one of the top doctors in Melbourne, and he said, look, this is being adopted everywhere. 70% of Australian hospitals now have it. They're beginning to export largely into England and United States and into Asian countries. So this seems a very interesting small cap. It's about $1 billion market cap, I think. And then we also have one gold mining company as a sort of hedge, really. We had some exposure there in the period before Brexit. We had cash and we had this gold hedge, and that did very well for us. And then I've lightened up a bit since then. So it's more of a tactical position.
Now, on September 30th, you will be launching the Indian Ocean Fund, and of course that's for accredited investors.
John, it's a Cayman fund, and I think we'll start with nearly $100 million. We've got some big seed investors. It'll be 75% invested in India, mainly in mid-cap stocks. That's $1 to $2 billion sort of range, consumer, healthcare, tourism, and those kind of areas. And then the 25% will be in Pakistan, Bangladesh, Sri Lanka, and Vietnam. And that's a formula which we came up with our largest seed investor who didn't want a single country fund. And I think there is real value in these very undervalued and under-researched and under-owned Asian frontier markets, where the conditions are similar to India. Demographics is favorable, politics reasonably stable, currency stable, and growth of 20 to 25% in earnings, and you're only paying 8 to 9 times earnings in some of these markets. They are relatively illiquid, so that is why we shall restrict to about 5% in each of those markets, and India will be the main bet. And the big news in India this summer was that they passed the goods and service tax at the beginning of August with a unanimous vote in the Indian Parliament. And I liken this to the single market in Europe in '92. They basically made interstate commerce in the 26 different states of India duty-free and with no special taxes or charges on interstate commerce. And this is going to boost GDP by 1 to 2%, and I think corporate earnings by 10% or upwards. It'll take a year or two to come through, but I think it's a very important development and also underlines Prime Minister Modi's strong political position now. So we expect him to be in power for a decade, really, and really reform much of the bureaucracy, the corruption, the slow decision-making in India, which has held up so much the infrastructure development and other things.
Well, in my opinion, the Lloyd George India Ocean Fund is one that family offices and institutions should pay serious attention to, and wish you the very best with that launch. And Robert, As always, thank you for a great update, and we'll look forward to catching up again soon.
Thank you, John.
Okay, folks, we'll go to a break, and when we come back, my interview with Dean LeBaron, who is the founder of Battery Marsh Financial Management, and you won't